Unshakeable by Tony Robbins. Confidence and serenity in a volatile world. Financial insecurity is one of the main sources of anxiety in contemporary life. People dream of having the peace of mind of knowing that they can meet their needs and supply some comforts for themselves and their families without worrying about a sudden recession or financial demand. You need the insights, the tools, the skills, the expertise and specific strategies that will empower you to achieve true and lasting prosperity. People long to be financially and mentally unshakable. They become unshakable when the fear of uncertainty doesn't govern them and the turbulent economy doesn't fluster them. Yet since the 2008 recession, the world seems fraught with uncertainty. Interest rates have been near or below zero and safe investments in bonds yield negligible returns. Even some top thinkers in the financial world are bewildered. The single biggest threat to your financial well-being is your own brain. If you're confused, the bright news is that a few people do have solid information and workable answers to your fiscal challenges. These experts have figured out how to reap substantial rewards in bad times and good. They include hedge fund manager Ray Dalio, index fund visionary Jack Bogle, J.P. Morgan Asset Management CEO Mary Callahan Erdos, oil billionaire T. Boone Pickens and legendary investor Warren Buffett. In interviews, these and other successful people from finance and business describe the precepts to follow to achieve true, lasting prosperity. To my horror, I discovered that our company's name brand 401k plan was loaded with expensive mutual funds, excessive administrative expenses and fat commissions. Though negotiating your financial life can be difficult and stressful, their strategies are straightforward and intuitive. For instance, no one can predict the future, so don't try. You can be a financial success without being able to see what the future will bring. Instead, keep your mind attuned to what you can control, not what you can't, and be sure to control what you can. Don't make decisions based on fear of the future. Since the economy always fluctuates, develop an informed plan that prepares you now for the next economic downturn. The crash on the horizon. Human beings develop the survival skill of being able to recognize patterns in their environment. This awareness is how the earliest people learned to avoid dangerous animals, to hunt where herds were likely to appear, and to know when and where to plant crops. Sustained civilized life depends on pattern recognition. Like the weather, financial markets follow patterns. Successful investors use those patterns to their advantage. You're never going to earn your way to financial freedom. The real route to riches is to set aside a portion of your money and invest it, so that it compounds over many years. The profound impact of compound interest fits a widely known, available pattern. Buffett attributes much of his vast wealth to the cumulative effects of compound interest. However, its dramatic impact depends in part on starting young and continuing over the course of a lifetime. In one modest but dramatic example, take a person who invests $300 per month from age 27 until retirement. With interest compounding at 10%, this person would amass $1,589,733 by age 65. People rarely become wealthy from a salary alone. The road to wealth and freedom is through saving money and making steady investments over the course of many years. Neuroscientists have found that the parts of the brain that process financial losses are the same parts that respond to mortal threats. Where should I put my money? Is a difficult but consequential concern. Given the 2008 recession and the current global volatility, the question is how to survive the next inevitable market downturn. Again, recognizing patterns is crucial. Learn to identify market patterns and use them. 7 facts. 7 attributes of market downturns should shape every investor's plan. Market corrections occur yearly. Few corrections go beyond a 10% downturn and turn into bear markets. No one can reliably predict a market upturn or downturn. In spite of periodic downturns, the market eventually goes up. Bear markets follow a consistent 3 to 5 year cycle. Market downturns become upturns, just as confidence turns into anxiety and fear. Getting out of the market altogether is the most perilous course. Paying for poor performance. Most people invest in order to save for retirement or to afford the freedom to live the life they want. Financial success and security enable you to choose the life you live. Unfortunately, the excessive fees the financial services industry charges can significantly degrade many people's investments. Research by AARP shows that 71% of Americans aren't aware that they pay fees on their 401k plans. Such excessive, often hidden, fees can eliminate as much as 2/3 of the value of a person's portfolio. Sadly, this suggests that many people believe, without justification, that the financial industry is prioritizing their interests. Most of the time, it is not. For an investor, eliminating excessive fees is a positive step toward a profitable future. Mutual funds and 401k plans. Many people searching for reliable, low-risk investments begin with mutual funds. On the surface, this looks like a good, fairly conservative choice. You can select among countless mutual funds and they diversify, which lowers your risk. But mutual funds are more profitable for the financial industry and Wall Street than for their clients. Corporations function with the overriding goal of maximizing profits for their shareholders, not their clients. The trouble is, sitting on the sidelines even for short periods of time may be the costliest mistake of all. Since fund managers trade stocks, they have plenty of room for human error. Every time they trade a stock, you pay an associated transaction fee. Even if the price of the stock rises enough to compensate for the fee, when you eventually sell the stock you have to pay taxes on the profit. Excessive fees and taxes can reduce the value of a mutual fund by 30% or more. Consider avoiding mutual funds and investing instead in index funds, which involve a few trades on a standardized index and thus invoke fewer fees and lower tax bills. If you don't understand the incentives of your advisor, you're liable to discover that you've done wonders for his financial future while potentially wrecking your own. The government invented 401k plans to allow people to make tax-deductible investments as part of their retirement savings. Most people with 401k plans are unaware that they're paying fees. Indeed, the government didn't require the financial industry to provide a detailed public accounting of the fees it charges 401k accounts until 2012, and, at that, it uses language most non-professionals can't decipher without expending a lot of time and patience. The financial services industry was charging multiple fees to people who put money in retirement accounts. For me, getting first-rate advice has been a game changer, saving me a tremendous amount of money and time. One researcher determined that, over a lifetime, an average worker who earns $30,000 and saves 5% of his or her income pays $154,794 in fees. The cost is proportionally higher for those with higher incomes. For teachers, nurses and nonprofit employees, it is even worse because the U.S. Employee Retirement Income Security Act of 1974 doesn't cover their plans. Industry lobbyists thwarted government efforts to eliminate these hidden fees. Be wary of financial advisors. Some 40% of Americans have financial advisors, and the percentage is twice as many for those who have assets of $5 million or more. Yet 60% of people surveyed in 2016 distrust financial advisors. They believe advisors act to fulfill only their own interests. Major financial firms have had to pay billions in legal settlements for misusing customer funds. One reason why diversification is so critical is that it protects us from a natural human tendency to stick with whatever we feel we know. While most of the millions of employees at major financial institutions are honest, some financial industry workers face pressure to find profits for their companies. They have an incentive to prioritize their employers over their customers and often, they yield to that push. Some 90% of 310,000 American financial advisors are in fact brokers whose principal purpose is to sell financial products. Their incentive isn't to protect customers' long-term interests but to sell and maximize profits for shareholders. Asset allocation is simply a matter of establishing the right mix of different types of investments, and diversifying among them in such a way that you reduce your risks and maximize your rewards. But you can find a financial advisor who's not a broker at a big firm. The right financial advisor can provide valuable advice on many different fronts, including investing, taxes, and insurance. Independent registered investment advisors are legally bound to prioritize their clients' interest over their own. They constitute only 10% of all investment advisors, but they're out there, and you can find them. When you're truly unshakable, you have unwavering confidence even amidst the storm. Many registered investment advisors also register as brokers and play both sides. Find the right independent advisor by confirming his or her credentials and qualifications. You want someone who knows how to work with people in your circumstances, to help you meet your goals. You should develop a relationship with your advisor, the person who should guide you to achieve your hopes and dreams of living an extraordinary life. Core principles. Successful investors like Warren Buffett aren't just lucky. They view and approach the world in a singular way. Obsessed with performance, they operate by conforming to 4 core principles that shape how they invest. Apply the core 4 as part of your investment playbook. Don't lose. Successful investors have a special aversion to losses because losing makes it harder to get back to where they began. This is a matter of time and money. You can waste years recouping losses. Successful investors protect themselves against unexpected events and nasty surprises that might set them back. Asymmetric risk/reward. The returns you expect should far exceed the risks you face. The purpose of any investment practice is to control risk and increase returns. Tax efficiency. Measure investment success by the net amount you retain. Don't ever ignore tax consequences. Mishandling potential tax liabilities can cost millions of dollars that an investor could otherwise put to sound use. Diversification: vary the different dimensions of your portfolio. Diversify the types of investments and the things you invest across different world markets and currencies, and, since timing can be everything, across time. The wealthy mind. When it comes to investing, people can be their own worst enemies. That's due, in part, to the evolution of the brain. When faced with a threat, be it an attack by a carnivore or a major financial loss, the survival instinct kicks in and people flee for their lives. Making financial decisions under that kind of pressure can lead to disaster. To compensate for this impulse, maintain an internal control checklist and have the discipline to follow it rigorously. A market crash may lack the immediate, mortal consequences of an attack by a saber-toothed tiger, but the consequences still can be catastrophic, like the destruction of your retirement savings. For investors, 80% of success is psychology and 20% is mechanics. Common errors. Investors are naturally prone to several common errors. Happily, these mistakes have relatively simple, easy-to-follow solutions. People tend to seek information that reaffirms their beliefs. That's confirmation bias. To counteract it, listen also to people who contradict your opinions. Like poker, investing is a zero-sum game. There are only so many chips on the table. When two people trade a stock, one must win and one must lose. Investors conflate recent events with ongoing trends because of a cognitive fault called the recency bias, giving more weight to recent events than to past experience when you are thinking about what to do in the future. An investor might purchase a stock with a recent history of strong performance. When its value drops, the investor will impulsively sell out. Avoid this by having a process for regaining your emotional balance and following a straightforward rule, like don't sell out when things get fraught. Another common error, especially in economically turbulent times, is to act out of fear of loss. Investors despise financial loss and might do anything to avoid it. Yet corrections and bear markets offer both risks and opportunities. The cure for the fleeing in fear is knowledge and preparation. If you master the external world without mastering the internal world, how can you be truly and sustainably happy? The true virtues and purposes of attaining wealth and financial freedom are gaining personal fulfillment and having an extraordinary quality of life. Without satisfaction and peace of mind, success and money mean nothing. The most important skill to master is the art of fulfillment. Takeaways: no one can consistently predict the future course of the stock market, but making predictions isn't necessary for success. To win the financial game, you must control what you can control. The secret to achieving wealth is compounding investments over a lifetime. Protect yourself against market downturns by developing a portfolio that is broadly diversified globally. Most people are unaware of the fees they pay financial services companies for managing their investments. People widely, and often rightfully, distrust their financial advisors. Make sure an investment's rewards outweigh its risks. The assets you acquire should mirror the nature of your financial goals. In volatile times, your brain wants to be fearful. Don't listen to it. Financial freedom enables you to live the life you want to live.